Welcome to the Stock Market Palantir. Today we are going to talk about OPNZ. The volatility around Open Door Technologies, ticker OPN, in late 2025 has been, nothing short of explosive. We're seeing this massive repricing event, all driven by the issuance of that special dividend of the Series Z warrants, OPNZ. So the central question for everyone watching is this powerful resurgence actually justified by Open Door's improving business and, the macro tailwinds? Or is it purely an unsustainable engineered event just designed to crush short positions? I'm going to argue that this structural move, the OPNZ distribution, was so effective because it was leveraging genuine identifiable improvements, magnifying a recovery that was, I think, already underway.
I see why you think that. And look, I'll grant you the ingenuity of the maneuver. It was clever. But I come at this from a very different angle. The rally we're seeing is, to me, overwhelmingly dominated by technical short squeeze mechanics, a lot of aggressive retail speculation, and a very high-stakes game of corporate leverage. It's masking some really significant unresolved risks in the core business. I mean, this move is fundamentally an engineered technical bubble built on a classic dividend trap, and I think we need to be careful not to confuse skillful short-term tactics with stable long-term value creation.
Okay, but let's establish the foundational case for what management pulled off here. The company executed a highly sophisticated maneuver, what, a lot of people are calling a weaponized dividend distribution, with the clear aim of fixing a very stressed capital structure and directly penalizing that short base. CEO Kaz Nejatian was pretty transparent about it. He said he was thrilled the move would, and I'm quoting, totally ruin the night of a few short sellers. I mean, that's management confidence backed by results. That's key.
Mm-hmm. And crucially, this all happened alongside massive risk mitigation. Earlier in 2025, Open Door was facing a serious threat of a NASDAQ delisting. They were even considering a highly bearish, value-destroying reverse stock split, something like 1 for 50. Abandoning that proposal, which they did, signaled to the market that the existential threat was over. And this stability was reinforced by real performance. Q3 2025 earnings reported a revenue beat of $915 million, which was way above the $850 million estimate. And then you have the macro shift. The Fed's rate cut in September lowered the 30-year fixed mortgage to 6.39%, the lowest in almost a year. That fundamentally changes the inventory velocity Open Door needs, so you have structural success meeting a perfect improving fundamental reality. That narrative of structural success leveraging macro improvement it's certainly compelling. But the sequencing of events, the actual timing, argues otherwise. The immediate and violent repricing was dictated by structural liability, not the small incremental benefit of a Q3 earnings beat or a 20 basis point drop in mortgage rates.
Okay.
The price action is driven primarily by this dividend trap. For anyone unfamiliar, a property dividend obligates short sellers to deliver the new property, in this case the warrants, to the original share lender. So to satisfy this liability, short sellers were forced into the open market to buy OPENZ pretty much regardless of price. That creates this intense, inelastic buying demand. That mechanism alone explains the volume spike far better than any fundamental reassessment of a $65 million revenue beat.
Mm-hmm.
And on top of that, these OpenZ warrants, they traded $1 or $2, but have a $17 strike price. So they're seen by parts of the market as just massive leverage, basically a lottery ticket. This fuels the gamma squeeze thesis, heavily embraced by communities like Wall Street bets. Market makers who are selling these warrants have to constantly buy the underlying stock, Open, to hedge their exposure. So you get this forced buying that's completely independent of Open Door's EBITDA. And speaking of EBITDA, let's not forget the weakness there. Open Door still posted an adjusted EBITDA loss of $33 million in Q3. The business is not self-sustaining yet, which is why major analysts, Citigroup, KBW, they're all maintaining sell ratings with price targets way below the $6 to $8 the stock was trading at. The price is it's detached from fundamental value.
I acknowledge the force of the dividend trap. I do. The data shows that hedging and short covering were huge factors. But I'm just not convinced you can maintain this clean separation between the market structure and the underlying belief structure of the investors.
Well, let's look at the microstructure data, because that really reinforces the timing. You're saying the fundamentals provided the confidence, but the trading volume screams forced action. Look at this spike right before the record date, November 18th. On November 17th, Opendoor saw a huge surge in off-exchange volume, a staggering 44.1 million shares traded in dark pools. Now for our listeners, dark pools are private venues where institutions trade large blocks. This, combined with a high short volume ratio of over 43%, that's not organic interest suddenly waking up to a slightly better balance sheet. That is the fingerprint of institutional shorts covering or hedging to mitigate their dividend liability. The mechanism was the immediate driver, not the fundamentals.
Okay, I grant you the force of that dark pool activity. It's definitive proof of institutional hedging. However, I still maintain this is a virtuous loop. The mechanics would have absolutely broken down without confidence in the operational restructuring, what they call Opendoor 2.0.
I'm not so sure.
If Opendoor were still fundamentally broken, short sellers would have just weeded out the squeeze, knowing the underlying value would eventually win out, just like you're saying the analysts believe. But they didn't. They capitulated because the risk profile shifted. Opendoor 2.0 isn't just a buzzword, it's a major shift to cost alignment, inventory velocity, focusing on margin over volume. When you couple this demonstrable operational improvement with the powerful macro shift to lower rates, you create an environment where a structural manipulation like the warrants magnifies a justified recovery. The warrants weren't the ignition. They were the supercharger for an engine that had just been repaired.
That's a very compelling framing of the virtuous loop, but let's not overlook the crucial psychological piece that really sealed the deal for the short capitulation. The CEO's aggressive rhetoric, that ruin the night comment, was expertly targeted. It successfully injected this unquantifiable emotional risk into the short trade. Institutional shorts are rational, but they avoid irrational environments. They closed positions because the operational complexity, tracking and settling 3 different warrants, combined with the fear of facing a retail mob riled up by management's taunts, made the trade rationally unmanageable. It forced capitulation based on fear and complexity, not a fundamental reassessment that the stock was suddenly worth 300% more. I think the primary success of the maneuver wasn't proving the Opendoor 2.0 thesis, but just creating an uninvestable short environment.
That brings us perfectly to the strategic implications of the warrant design itself, which I believe demonstrates management's long-term foresight. I'm talking about the $20.40 early expiration trigger. I argue this is a key protective feature for Opendoor and a sign of really robust capital management.
Okay.
So for our audience, the trigger is set at 120% of the $17 exercise price. If the stock trades above $20.40 for 20 out of 30 trading days, Opendoor can immediately force warrant holders to exercise or sell. This lets the company clean up its capital structure by forcing the conversion and at the same time raise a massive amount of cash. We estimate $1.7 billion if all the Series Z warrants are exercised. This isn't just tactical, it's a brilliant, flexible funding mechanism tied directly to the success of the business.
I'm sorry, I just don't buy that the trigger benefits the current speculative buyers who drove this price action. While it certainly sounds capital management for the company, I agree it acts as a very real liability for the typical retail investor who jumped in at $6 or $7.
But how so?
Well, for the investor who's in this to hold for the moon, that 2040 trigger is a hard cap on the duration of their upside. If the stock hits that level, the company just cuts the timeline short. It completely interrupts the speculative theses, it moves the goalposts, and it adds a layer of complexity that many retail buyers chasing the cheap OpenZ warrant probably fail to appreciate or even understand. It signals that this is a highly tactical trade with a corporate escape valve, not a traditional long-term investment.
But isn't the alternative far worse? You can't ignore the necessity of repairing the capital structure. Let's look at the long-term dilution concern you mentioned, but in the context of what they were trying to avoid.
Indeed. The primary long-term cost here is dilution. The issuance of all these warrants, K, A, and Z, creates a significant potential dilution overhang of about 100 million new shares. That's roughly 10% dilution to existing shareholders. That raises the bar significantly for future earnings per share. We already talked about the 33 million EBITDA loss. Adding 10% more shares that need to earn a return makes that climb substantially steeper.
That's an interesting point. Though I would frame it differently. You have to weigh this future contingent dilution against the immediate and certain value destruction of the reverse stock split the company was facing. avoiding that reverse split was perhaps the single most important action they took. Reverse splits signal failure. They damage credibility, they just wipe out shareholder value. By issuing these warrants, the company secured the ability to issue equity at a premium, $17 per share, at a time when the stock was in the single digits. This is a strategic funding mechanism. They only get the capital if the market believes the stock is worth that much more. So they chose success-based, premium-priced future dilution over failure-based immediate value destruction. That is sound management.
I agree that avoiding the reverse split was crucial, but it was a tactical necessity, not proof that the Open Door 2.0 thesis is working. The fact remains the stock is trading far above any rational price targets from major firms, based on a business that is still posting losses. So while the maneuver was skillful and avoiding the split was a huge win, it's created a highly unstable valuation built on technical leverage.
And I counter that stability is secondary to solvency and strategic positioning. The maneuver delivered both, and it leveraged a positive macro trend that is now moving housing velocity back into their favor. So, to conclude my position, the successful warrant maneuver demonstrated extremely sophisticated management. It strategically leveraged legitimate, measurable macroeconomic tailwinds, specifically the decline in mortgage rates, and the genuine operational restructuring in Open Door 2.0. This delivered a critical path to capital structure repair and established a framework for premium future capitalization. This benefits long-term shareholders, provided the housing market continues its recovery. The structural event was a catalyst, but the underlying fundamentals were the necessary fuel.
And my view remains that while the structure successfully squeezed short positions, a tactical, masterful victory for sure, the current valuation is fundamentally detached from the reality of the business, which, again, still posted a significant $33 million EDIS loss. The current price action is underpinned by technical and speculative buying that is simply not sustainable. I think investors need to be highly aware of the short-term tactical nature of OpenZ's, especially with that looming $20.40 expiration trigger and the significant long-term dilution risk that will eventually impact earnings.
Open Door's situation really is a perfect storm where sophisticated corporate financial engineering, volatile retail psychology, driven by that preference for low-priced, high-leverage instruments like OPENZ, and macroeconomics have all collided. Our key disagreement remains whether this engineered volatility signals a stable, lasting pivot toward sustainable strategic dominance, or if it's just a fleeting opportunity driven by complex technical liabilities designed solely to liquidate the short base. Thank you very much for hearing us. Let us know in the comments what is your opinion. And if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.